There's one thing from the 1929 stock market crash that no one talks about. I've never heard anyone talk about it, but it actually impacts today more than anything else. Yes, almost, but not quite, almost 100 years later, this one thing impacts investors today. And I'm going to talk about that and a couple other goodies. All right, guys, there are three things that come from the 1929 stock market crash that almost no one talks about, but it absolutely impacts every investor today, whether you are 70 or 17 or anywhere in between. And we absolutely have to talk about that. Now, even if you're not a trader, or if you're a long-term investor, or you're a swing trader or a day trader, an option trader, or you just own bonds, but you have money in the market, this is absolutely going to matter to you because it impacts how your money grows and how it actually decreases if that's happening. So let's get into those three things that matter most from the 1929 crash. Okay, number one. I'm gonna bring the biggest one out first. In 1929, there was this price support, meaning price could not get below. Now I'm looking at the Dow Jones, right? And so the Dow Jones could not get below 300 points. Literally, the Dow Jones would go up and then come down, and at 300 on the Dow Jones Industrial Average, buyers would come in. They'd buy it every time the Dow got down to $300 or 300 points. And this is really important because that is a support. People were coming in, buyers were coming in, demand was coming in for the market when the Dow was at 300. Okay, now this is very important because this happens today in everything from Bitcoin to Tesla to even bond prices. Polarity happened, and we're still on the first one. What I mean by polarity is then later in the year in 1929, when the market went back down to 300, Dow 300, okay? Sellers came in, supply came in, people supplied the market with their shares, right? And the market absolutely crashed through 300. So first of all, these are called price or resistance supports. They are absolutely in use today and helps people grow money, helps with their price, helps find strength, and it helps with signal. So back in 1929, this was going on. What this tells you is human nature has not changed. Now, of course, it hasn't quite been 100 years, but let's just round up and say 100 years. So in 100 years of everything that's changed in the world, group human behavior is exactly the same. And you can see if you look at a price chart from 1929, actually, let's go 1928 to 1934, you can see that $300 price, all right? And when it broke through it, that was a very significant point for people to go, something has changed. It's the same thing today that I show people. Know these price resistance supports. But it gets better. We're still on number one. When the market broke through from the peak to the first big fall down, it fell 50% in about 70 trading days. That's still happening today. That's a huge fall, losing 50% of value in about 72 calendar days. I said trading days a second ago. It's actually calendar days. But that's not the big deal. The big deal is the market then came roaring back, went up 50%, and went right back up to that 300 mark. But this time, sellers came in again. So the biggest thing from 1929 is how much things have not changed. Price matters, price support, price resistance matters so much. You have to understand how to read price charts, but that has not changed. So the biggest thing is price support, price resistance was happening back in the 1920s, and it still happens today. So that's the biggest thing. Okay, number two. Here's number two. It took 3 years for the market to finally bottom. 3 years. Officially, it was about 35 months, but I'm going to round it to 3 years. The reason why this is number two is most people think that markets just collapse in a day. Now, I know I said to you a minute ago that the market fell 50% in 72 calendar days. Guys, it fell 34% in 30 calendar days back in the COVID crash. That's about the same pace. So that thing is still happening, that really fast correction, though a 34% fall is much different than a 50. But here's point number two, 36 months, 3 years to do its full fall. Most people think markets just collapse overnight Even the super, super, super fast ones, they take time. So the second thing is to know that, look, in 1929 or the 1929 crash, it was 3 years of the market falling. 3 years. That is a long time, considering that I think in 1930, the life expectancy was around 60. So 3 years, relatively speaking, is a lot longer. So number two is it takes time for the market to correct, not just, overnight or one night. I'm talking about huge stock markets. Now, the thing I want to say to you about the 1929 crash in the US is the US was a startup. This is not point number three, but I just want to make this point. This was a startup. The US was a startup, right? This wasn't Great Britain. This was the US. Just a little bit before that, we were in this huge, huge civil war, like not too far before that, about 70 years, right? So this was a startup company, and you'll see that in frontier markets or emerging markets around the world. You'll see these 50 to 60 to 70 to 80% corrections. That's normal. The US is not that anymore, and we will not ever have a 90% correction, which is what it was. Now, the NASDAQ fell 83% in the .com, but the NASDAQ is not the stock market. The S&P only fell 50% in the .com. So number two is it took actually 36 months. It took a long time. That is a long time to fall 90%. Okay, here's the third thing that people really, really get hurt on that we can really learn from. Even back then in 1929, 1930, 1931, 1932, we bottomed in almost August of 1932. There were, and I just want to check here, there were 6 20% rallies. Now there was a 50% rally, but there were 5 other rallies. So during that 35 and a half month fall, 3-year fall, there were 6 times that the market fooled people, pulled them back in only to have them lose almost all of their money. And that's why understanding a signal is so important, because we're going to get these false rallies all the time when the market's in one of these systemic falls. That hasn't changed either. So the 3 things are: 1, price resistance and price support mattered back then, and it still matters today. Number 2, it was actually a 3-year fall when the market fell 90%, which, by the way, is actually more common than you think in frontier markets. And number 3, there were 6 20% rallies, which often and also also happen today. The human condition has not changed. Even though there's probably like only 20 people in the stock market back in 1929, really, guys, not many people were in the stock market way back then. It really was only until 1981 when the 401k was introduced into the US that people really started investing in the stock market. But the biggest takeaway from 1929 is we are still susceptible to group behavior, right? We know price support still matters. We know there's all these false rallies in a bear market. So as I kind of pull this together, the biggest thing to really understand about 1929 is we as a group, we as humans, we still behave the same way, and understanding where those price supports come from. At the beginning, I said 300, that Dow Jones 300 was that support. It was the support, it was the support. And then the sellers came in and it became resistance, resistance, and resistance. That still happens today. So 1929 does matter, simply because when you look at a price chart of it, you can see, oh my gosh, nothing has changed today. And you go, oh, wait a second. Understanding signals, understanding when strength leaves the stock market, understanding how to read price, none of that has changed. Thanks, guys. I appreciate you watching this video. And if you like this video, you will love our free course, Clarity and Control. Check it out in the description. Also, too, please ring the bell, subscribe, leave a comment. Tell me where I got it right. Tell me where I got it wrong. I'm open to discussion. Thanks again, guys, for being in my world, and I will see you on the next video. Okay, bye.